Traders, welcome. Hope everyone's good. Follow-up video from our previous options presentation that we carried out. So today we're going to deep dive more into GEX, options, expirations, and how all of this comes into effect. Okay, we're going to try and keep this as short and sweet as we can because there's a lot to cover. So in the video here, we are going to deep dive into the gamma exposure, your zero data expiry options, and your best friend, soon to be your best buddy, is going to be the HVL gamma flip zones. Okay, because if you're not paying attention to this, then there's pretty much no point of even really using this solution. Okay. So, unless you have not checked any of the literature or seen the previous video, you're probably thinking, well, how does positive GEX versus negative GEX affect things? And just generally speaking, market makers hedge against the volatility, so they sell the rallies and buy the dips when there is loads of positive GEX or in a positive gamma environment. Okay, and that essentially just reduces the volatility. So that means it's nice and controlled. Doesn't mean, and this is the key, doesn't mean that the market can't go up the way or you can't have a one directional day. It just means that when it does move, it's going to be more controlled. The volatility and swings are less. Conversely, when there's a lot of negative GEX, market makers hedge into these sell offs and they buy and chase the rips. Okay. So it's a completely different environment. Now, for you, you need to then be structuring your trades and your plan of attack depending upon which regime the options are. So, really, momentum trades in general work better when you are in a negative gamma environment and there's tons of negative GEX below. And fading typically works better when you're in a positive gamma environment and there's loads of positive GEX. Okay, so we covered some of that in the previous video, but we're going to jump into how this transitions um, between today's expiry, for example, and the likes of Friday, because this updates every day. Okay, and you need to have your morning routine with your morning coffee and be ready with a game plan for how all this pans out. Okay. So the general key concepts you're going to find on the likes of MentorQ or whatever platform you use. We're going to link some stuff in the description for you for this. But the call resistance are areas of high positive GEX where the price often then stalls. Your put support is areas of high negative GEX where the price often holds. Okay, they act really as sticking points and a nice area for you to fade. Again, the fades work better if it's in a positive gamma environment. Okay, now the one of the easiest trades that you're going to have for some momentum is when the market shifts from a positive gamma environment to a negative gamma environment, and this is going to happen at your HVL line or the gamma flip level. Okay, there is two that you're going to have on your platform. There's going to be the zero DTE, and there's also going to be the overarching contract. Okay, you need to make a note of these, especially for the Friday ones as well. So you will need to make a note of that, write it down, and really pay attention to these levels. But generally speaking, when you're just above the HVL line, it means any upside move is going to be controlled. Whereas if we do flip below the HVL line and there is some more negative GEX, if you do take out options levels, the volatility to the downside is going to be far greater. Okay. Now, in your zero data expiry stuff, this essentially, the reason why this is important is because the dealers need to act now. They need to do stuff because it literally has to be off the books by close of play that day. Okay, so it has a massive bearing on the market for only for that specific session. Okay, the following day does not matter, that's in the bin. Okay, so we're going to deep dive more into these specific concepts as well. And generally speaking, why the gamma exposure matters. Okay, if there is a lot of positive GEX expiring, it means there is less potential hedging required in the market. Okay, And if there is more negative GEX expiring, it means there can be a shift to positive gamma, and then there can be more hedging. So from if we're going to deep dive here later in the slides where how this transitions on a Friday. So when you have a lot of positive GEX expiring on a Friday, that needs to be out the way and basically balanced off the books before the market can then essentially have some volatility to the downside. Okay, so if you're looking to take any momentum plays and start selling the market aggressively in SPOs, then you really should be doing that around when the options positions shift. And they'll give you a key clue because they don't just doesn't just happen in one day, especially when there's no news. News catalysts are a different kettle of fish. So the GEX shifts daily. We've got a case study that we're going to run through this. You need to be checking this every day, regardless of the market you're trading. If it's ES, even more so because there's much more that goes into that for the zero data expiry stuff. You've got the underlying, you've got the individual equities below it, you've got SPX in there too, maybe even the Qs. So you really need to be checking this because it can transition a lot from there. Okay, so you're checking this every day, you're comparing what happened today versus yesterday and seeing how much has been added to the book versus what's been taken away. And it really allows you to determine what's likely to happen for the session. Where is the market going to stop? Are we likely to do anything? Where is the point where the market needs to have puking points? And where is the volatility really like to come in for that session? Okay, because if you don't know this, then you're just basically trading blind from there. When you start coupling this with order flow and everything else that we have in the channel, this gives you in essence, your range and your volatility gauge. And the hardest thing that traders suffer with is the changing conditions and changing of regimes, and the options are there to give you an idea that, hey, this can potentially change now. So it gives you a heads up. There is no other tool, there is nothing, there is no indicator that you can utilize out with the options flows that gives you a heads up that there is more volatility incoming. Okay, so this here for this is for Thursday and Friday this week, just gone by, May the 29th and May the 30th. So on Thursday, you show up, you've got your morning coffee, you're ready to rock and roll, right? For Thursday, the zero data expiry was negative 10% GEX. So what that tells you is 10% of the negative GEX is expiring today. Okay? You always check the Friday expiration because that's the expiration where all of the business is closed off for the week. It's always on a Friday. Okay, you check how this adds and contracts every day. So you show up on the 29th, right? You see, okay, there's 10% expiring. Where is the put support? Where is the HVL? And where is the call resistance? So that day then goes by, and there is 14% to expire on the 30th. When you get to Friday, you then see, okay, there is now 24% expiring here. Okay, so you can see just very simple math that there was an extra 10% that has been added to the book of positive GEX. Okay, so that should tell you that it's not very likely that the market is going to do anything crazy wild. Now, you need to really use your brain here because can the market go crazy if there's going to be data that comes out? Yes, of course it can, right? But really, it's not going to be all hell for leather until all of this positive GEX expires because the dealers are basically buying into sell-offs and selling into rallies when all of this positive GEX is on the books. Okay. And generally speaking, the HVL, there'll be a shift in the HVL2. It will gradually move towards price and then it will be above price. It doesn't just happen crazy. Okay. You get about a day or so for this to really change and you can see how everything updates. Okay. But you really need to check this every single day and this gives you the plan of attack and game plan for the session. Okay. Now, what is then going to be the indicators of downside volatility? Okay, now we've covered this in the past on the channel for different videos. Okay, some people are not even using the VIX or don't even know what the VIX is, which is wild in 2025. Okay, and really the downside volatility is not going to happen until a lot of the positive gets expires or it's at least done and dusted. That's why Monday, Tuesday, if the week is to start with some volatility, it normally happens then is all the positions start to get balanced. Okay. This will be coupled with a rising VIX. And then when it comes to the Monday, for example, you will normally see the HVL will be moving closer towards the price, whether that be on the 0 day to expiry HVL or it specifically be the gamma flip line that is for the overarching contract. Okay. And ideally, for the market to shift down really quickly, there needs to be a lot of GEX added below, because that means that as we go down the way, the dealers are having to aggressively sell into the price. Okay. And these flip zones are the easiest to trade, especially when it's flipping from positive to negative, because there only is downside volatility, the upside is controlled. So it keeps it in a nice regime for you. When you're miles below the HVL line, it can go both ways. It can go back up towards the HVL and then we become more positive gamma, or it can continue down the way. It really depends on what the conditions are. But for it to be completely shifted, it takes a couple of days if you're miles below or miles above the HVL line for the conditions to completely shift. Okay. But in general, as we said earlier, when you're in a positive gamma environment, the market's just more controlled. Implied volatility is less. Okay. Whereas in the downside, that's the time where the options dudes are collecting more premium, the volatility is higher. Okay. So you need to factor all of this into your trading. The market just expects higher percentage moves in a day when you're in a negative gamma environment. Okay. Now, zero DTE options, I would say they have a much bigger impact, of course, on if you're trading ES or NQ. They have way more pieces to the puzzle because you've got the individual equities in there. You've then got the ETFs, you've got the underlyings too. So you can add within Mentor Q, you can add the 0 day to expiry levels so that they track and update and you can see everything shift and change on the day. But the general reason why they're important is because if someone comes in and buys a huge size or sells huge size, the dealers need to act now because the stuff is expiring today. It's the stuff that has the most gamma exposure for that session. And the one thing is with dealers and options, with 0 day to expiry, they don't have the time. With everything else, if you go and buy something from options and the expiration is say next month, the dealers are not doing anything about that right now. But if you buy something today from them that expires today, they will need to act on that now. So that's why it has such an impact and why the market goes to specific levels, because the dealers will either add or contract the volatility depending on what is happening. Okay. So they're not as important for the likes of, say, corn or treasuries. I mean, of course, there is some options plays in there. Really hard to get the data, to be perfectly honest with you. But the overarching contracts for the HVL line, it doesn't shift that much. I mean, you're maybe talking on ES, it's maybe 10 to 15 points, for example. So it can add an extra 5% or so edge, and you can see how everything shifts and changes. But as long as you've got a good idea of where these levels are and where they're either likely to shift, stop, fade, it really puts you in a good spot. Okay. Now, I've said here about the Friday expirations. Okay. You This is where all the business is done. This can shift massively in a week. I think if you want to go on to Mentor Q, for example, and have a look at last week before the Trump said he hates Europe and he's going to put on 50% tariffs, the options flows changed on Wednesday. We actually opened just below the HVR line across the board, and there was a lot more negative gex added. The flows completely shifted from positive gex to negative gex across the board. And it gave you a heads up that, hey, there is more volatility to the downside. And of course, anything mean that Trump says, right, is always going to negatively affect stocks. You know, that's just the way it is because the regime at the moment is the market is basically pricing in an average tariff, and Trump is basically just throwing in curveballs. So the volatility is normally to the downside. Call me a cynic, but some of this stuff could potentially be leaked. It's a bit of a coincidence why options flows um, essentially change a day to 2 days prior to all of this. Okay. Plus, as well, on the Thursday, you had the tail in the 20-year bond auction. So that didn't help matters as well. But the general concept that I'm suggesting here is you will know that there is some volatility afoot if you're checking this every day. Okay. And it lets you know if there is a tight session, a pinning session, or if there's anything crazy to happen. And that is where options come in. Okay. It's the only thing that you're going to get a heads up for to be able to know that the volatility is shifting. And that's the number one thing for doing this for years and dealing with a number of trading cards is people go from regime shifts to volatility changes, and they tend to use the same strategy continuously and expect the same results. But that's just not how it works. You need to have different outlooks, different strategies for different side of things. Just for example, if you're in a negative gex, you're better to trade momentum, whereas if you're in a positive gex, you're better to be fading back into the mean. Okay. Now, that is not completely gospel. You need to be taking into account the order flow. The order flow is absolutely king. Okay. Doesn't matter what the options flow is saying. If someone's come in and absolutely whacking the offer with thousands of contracts and the bid is really strong, should you be fading that? Probably not. You need to use your head. This gives you a guide, but the actual what is happening in the hard right edge dictates the now. Okay, that's why the DOM is so important. That's why you need to know how the bid and ask interacts. Okay, now putting this together, morning coffee, right? You're sitting down in the morning, you're getting your plan of attack, you're feeling good. Okay, you need to put together a plan. You need to see how is the gamma flip level, how has that changed versus yesterday? Has there been more stuff added to call resistance and put support? I.e., has there been positive gex added or is there been negative gex added? Okay. How much of the expiring gex was off the books? Was that negative yesterday or was that positive? How has Friday changed? Is there been more stuff added to Friday or is there not? Okay. What's happening today? Is there more stuff expiring today? Is it positive or negative? Build all that into your setup. You know, what data is on the docket today? How is that going to impact stuff? Is the market already priced in? What is the Fed saying? Okay, so you've got your rough plan of attack and building this all into your narrative for the session. Okay, and watch how this shifts and changes completely. It'll make a massive difference if you go in with a game plan like this and allows you to know which levels are going to be super sticky. Because if you're targeting them, you're probably better taking profit there or potentially even fading off them. Okay. But if you didn't know where the GEX was for days ago and you're not doing any prep, I mean, you're basically pissing in the wind. Okay. So put all this together when you go on MentorQ at whatever platform, check it out, right? Check the daily expirations of what's happening. How did that differ to the day before? Has anything been added to the Friday expiration? This does not matter what market you're trading, by the way. It can be corn, it can be hogs, it could be orange juice for all I care, right? Once you get this in as your pre-market prep, you're going to be a much better spot. And then it's down to the flows. Then you just need to wind your neck in, focus, get some coffee. Every tick matters as well. Okay. You never need to enter the screw it state. We'll just wire in. Okay. Now I've already been harping on a lot in this video here, But the general theme is the GEX tells you the story of the hedging and the volatility, and you always need to be on the right side of volatility. Okay? When you're in a positive gamma environment, it doesn't mean that you can't go up. It doesn't mean that fading is always the best strategy. Okay? It just means that to the upside, you're going to have a calm, more controlled market. When you're in a negative gamma environment and there's tons of negative GEX below and you break some HVL lines, there's going to be way more swings. Okay? And the zero day to expiry stuff just lets you know that there is potential fuel that can be added to the fire at these key inflection points. Okay, you need to know what the inflection points are. And then every day you need to take the note of the Friday expirations and how they change because they are critical. Because the market is not going to go down crazily on a Friday if there's 24% GEX is expiring. You're not going to have crazy volatility to the downside. That needs to be off the books. Then there needs to be more negative GEX added. The HVL needs to come towards price, and we need to have an options flow shift. Okay, that happens over a couple of sessions, right? Now, I think the next video we're going to deep dive into the Mentor Q platform, specifically itself. Um, but all of this, you can go into the first expiration and your Friday expirations. You can do it on the actual platform and have a look at it. You need to be noting, you can just check it on the platform, go back previous days, right? You can do that. However, I would probably say you need to write this stuff down. You need to get into a routine of doing it all from there. And of course, if you're not using the integrations there will give you the overarching contract as well as the zero data expiry. If you're trading ES, then you can add in the intraday levels. If you want to comment in the comments below and let me know, I'll do a video on how to add in the zero data expiry stuff. Just bear in mind that I trade on Sierra charts, so it's a bit of a pain in the neck with Sierra. Nothing is easy on that platform, to be honest with you. Um, but we can cover that because that adds a little bit of an extra edge, for example, for you to see. But you need to focus on the meat and potatoes and not worry so much about the couple of percent side of things. Okay. Now, hope this has been relatively short and sweet. Okay. If you've got any questions, please let me know in the comments. Do all the YouTube stuff, like and subscribe, tell your gran, let your mum know. And if you need any one-on-one time or you want to have a look at that, check out the coffee and let me know what the script is. You guys have an awesome rest of your weekends and we will catch up soon. Peace.